Clean prices and dirty prices. The coupon bond in the previous section was issued at a price of $995.86, which implied a semi-annual yield to maturity of 1.023%, or a bond equivalent annual yield of twice that, 2.046%. The full formula used to calculate the present value was the following: 10 over 1 plus r, that's the first coupon, plus 10 over 1 plus r squared, that's the next one, plus 10 over 1 plus r cubed, and so on, up until the very last payment, which is $1,010 divided by 1 plus r to the t, that's the principal repayment plus the last coupon. And if we plug in a r of 1.023%, we get a price of $995.86. I mentioned that by March 6th, this bond was trading at more than that, at a price of $1,005.50. That was the price quote on the WallStreetJournal.com, alongside a yield quote of 1.939%. Recall again that it's standard to quote these in units of $100, so you'd actually see $100.55 as the quoted price, but the actual bond price is 10 times that, or $1,005.50. So let's check whether we can square the price that the Wall Street Journal quoted for this bond with the yield that they quoted for this bond. On March 6th, we were 19 days closer to the date of the first coupon payment than when the bond was issued. So we were 10.5% of the way through the first 6-month period. 10.5% is 19 divided by 181, which is the total number of days in the 6-month period. So that means that discounting that first cash flow back to March 6th, we have to use an exponent, not of one period, but of 0.895 periods. And discounting the second term, we want to use not 2 periods, but 1.895 periods, and so on. So doing our discounting, 10 over 1 plus r to the 0.895, plus 10 over 1 plus r to the 1.895, and so on, where the last payment is 1,010 divided by 1 plus r to the 19.895. If we plug in the semi-annual yield, which is the 1.939% divided by 2, that's 0.969%, we find a price of $1,006.55. But wait a second. That price is not consistent with the quoted price of $100.55 per $100 of face value, or $1,005.50 for a $1,000 bond, even though the $1,005.50 was quoted on the website alongside the yield to maturity of 1.939%. So what gives? The apparent discrepancy has to do with the way that prices are quoted when bonds are between coupons. Trust your math. If you wanted to buy this bond on March 6th, you would actually pay $1,006.55, as you calculated from your formula, as an invoice price, sometimes also called a dirty price. But bond prices are quoted online and in newspapers and on many trading systems using clean prices, which typically do not include the accrued interest. Remember that in this example, on March 6th, you were already 10.5% of the way to the first coupon payment. That is worth 10.5% times $10, or $1.05. That's the difference between the dirty price you actually pay, $1,006.55, and the clean price that is quoted, $1,005.50. The difference is that $1.05 of accrued interest. So the relation we have is as follows. The dirty invoice or present value or actual price is equal to the clean or quoted price plus accrued interest. Why quote a price that's not actually paid? Let's try graphing out the present value, that is the dirty, true, or invoice price of a bond over time, starting from a point where the yield to maturity is the coupon rates. The bond is trading at par. You will see its value fluctuating in a sort of jagged pattern just because of the timing of interest payments. Changes in clean prices, on the other hand, actually reflect some change in the economics of investors' desire to hold the bond. When the yield to maturity on a bond equals the coupon rate, the bond is referred to as trading at par. But recall that on March 6, 2013, this bond was actually trading at a yield to maturity that was lower than the coupon rate, so it was trading at a price that was above par. How do the clean and dirty prices change as this type of bond matures? The clean price is still a straight line, and the dirty price is still jagged, But now we have the price of the bond declining down to the $100 face value principal repayment as the bond approaches maturity. This is because the advantage the bond has of paying a coupon rate that is higher than the market interest rate diminishes as the date of maturity approaches. So if the price of a premium bond declines as the bond approaches maturity, do I lose money by investing in such a bond? No. Despite the capital loss that will occur, you don't lose money by investing in this bond because you are getting those above-market coupons from the outset. So to recap, the prices and yields you see online for U.S. bonds will not exactly match up unless it happens to be the exact day after a coupon was just paid, or if you do a correction for accrued interest. The price you see in the Wall Street Journal or on the wallstreetjournal.com or Bloomberg or Reuters is usually the clean price if we're talking about a U.S. bond. That clean price is not the price you actually pay to buy the bond or the price you receive to sell the bond. You actually pay the dirty or invoice price, which will be the clean price plus any accrued interest. It's important to pay attention to whether you're looking at a clean or dirty price quote. While in U.S. markets, we typically quote the clean price, in some European markets, quoting the dirty or true invoice price is more common. So if you invest in bonds, make sure you know what kind of price you are being quoted. In the U.S., if you think you are buying at the quoted clean price, you are not. The actual price you will pay will be higher. And in Europe, if you're selling a bond and think you're going to get additional accrued interest beyond the price you were quoted, you will be disappointed when your sale goes through to find out that, in fact, you were quoted the actual dirty market price.